All right, let's get right into it. We're going to talk about something that sounds so small, so insignificant, but it has this incredible power to completely change your financial life. I'm talking about that tiny 1% fee that a lot of financial advisors charge.
Whoa, okay, that's a pretty intense statement, right? What could that possibly be describing? Some kind of Wall Street scam? Predatory lending? No. The person who said this was talking about that exact same, totally normal 1% fee, and we're about to find out why.
I want you to just picture this for a second. You're sitting in this super slick conference room, all glass and polished wood. And across the table, this really sharp-looking advisor is explaining their super complex proprietary investment strategy. It all sounds incredibly sophisticated, very exclusive.
And then they drop the magic words. It's just 1% of the money they're managing for you. See, they say, our interests are aligned. If we make you money, we make money. It sounds so simple, so completely fair. And that right there is why it's so dangerously effective.
So here's the problem. Our brains are fantastic at doing simple math, like 2 plus 2 is 4. But we are just awful at intuitively getting how compounding works over like 30 or 40 years. So it seems like a tiny little fee today. Well, it morphs into a monster over a lifetime. To really get this, let's invent an investor. We'll call her Sarah, and we're going to watch what happens to her money over the next 30 years in 2 totally parallel universes. In one, her nest egg grows beautifully, but in the other, well, there's this tiny parasite, that 1% fee, that's just quietly siphoning off her wealth year after year without her even noticing how much it's really taking. Okay, so here's the setup. Scenario A, Sarah hires that sharp advisor and pays the 1%. Scenario B, she goes with a dead simple, super low-cost index fund portfolio that costs her just 0.04%. Now look, everything else is exactly the same. Same starting cash, same monthly investment, same 30 years. The only thing that's different is that tiny little fee.
And boom, 30 years later. Look at this. Now, in scenario A, Sarah's a millionaire. She's thrilled, right? She has 1.9 million bucks. But then you look over at scenario B. That gap? It's not a small gap. It is a life-changing canyon that was carved out by that just 1% fee.
Let's just put that number by itself. $434,000. Let that sink in. That's a house in most parts of the country. That's a solid decade of travel and fun in retirement. That is the chunk of wealth that was quietly transferred out of Sarah's future and into her advisor's pocket.
And this is the part that will absolutely change how you see this forever. It was never about 1%. In the end, that fee ate up almost 19% of what her retirement nest egg could have become. The fee wasn't on her gains, it was a tax on her final destination.
Now I can already hear the pushback. Advisors will say, whoa, it's not just about the math. We provide real value. We have active managers. We do tax stuff. We're your coach. Okay, fair enough. Let's dig into that. Let's see if that value is really worth it.
So the first big selling point is expertise, right? You're paying for these genius fund managers who are supposed to be able to outsmart the market and get you better returns. It's a great story. But what do the actual numbers say? Well, the data it's brutal. Over any long stretch of time, like 15 years, a whopping 90% of these highly paid professionals fail. They don't beat a simple, boring index fund. So think about that. You're literally paying a premium price for a product that is statistically guaranteed to underperform. It's wild. Okay, next up, tax optimization. Things like tax loss harvesting. And this stuff is valuable for sure. The problem? Technology has basically turned it into a commodity. A simple robo-advisor can do all of this for you automatically, probably even better than a human can, for about a quarter of the price. You just don't need to pay a 1% fee for this service anymore. And that brings us to the last, and I gotta say, the most legitimate argument for a human advisor, behavioral coaching. This is the big one. This is about paying someone to be the firewall between you and your own worst instincts when the market is crashing and you just want to sell everything. And let's be totally clear, if you are that person who panics, this service could absolutely save you way more than the 1% fee costs. It can be a lifesaver. So, if you don't need that behavioral backstop, what's the alternative? It's a strategy so simple, so elegant, that the fancy financial world almost looks down on it. It's called Vanguard and Chill, and it's basically about owning everything for almost nothing. This is it, the whole shebang, the famous 3-fund portfolio. It's so beautiful. Step 1, you buy a fund that owns the entire U.S. stock market.
That's your growth engine. Step 2, you buy a fund that owns the rest of the world's stocks for diversification. And step 3, you buy a fund that owns the whole bond market. That's your shock absorber when things get rocky. That's it. 3 funds and you own the global economy.
And the price for this incredible portfolio? About 0.03% per year. It's practically free. And the work involved? You log in once a year to make sure things haven't gotten too out of whack. That is literally it. Now, compare that to the work and the 1% costs we've been talking about. It's not even a fair fight.
Okay, so let's wrap this all up into something you can actually use. How do you decide? How do you know if you're someone who might actually benefit from a 1% advisor, or if you should just buy the index and chill? Let's build a really simple framework. Here it is, the decision tree. You might, and I mean might, need a traditional advisor if your financial life is legitimately complicated. We're talking to you selling a business, you're setting up complex trusts, that kind of stuff. And, like we said, if you know deep down that you are a panic seller, an advisor can be worth their weight in gold. But for almost everybody else, probably 98% of us, the math is just crystal clear. The winning move is to buy the whole market, hang on tight for a few decades, and just chill.
And I want to leave you with this last thought because it's so important. The financial industry loves to sell you complexity. They use jargon and complicated charts to make it feel like you need them to navigate this dark, scary world. But as we've just seen, the simplest, cheapest solution isn't just a decent option, it's mathematically the best option for most people. So the real question you have to ask is, are you paying for advice or are you just paying for complexity?